This market is flat out insane right now. Stocks are hitting all-time highs while there are some major issues looming. Volatility is creeping in, investors are getting nervous, and worst of all, almost every person currently investing in the stock market is ignoring the single biggest issue. Now, that doesn't mean people aren't paying attention to this. There are articles out there talking about this looming issue, and I'll get to that shortly. The market has had some red days recently, and they were big ones, and it didn't take much to shake people. That's what should worry you. Just a little dip, and all of a sudden you start to see how fragile this market really is. Because underneath all the excitement and all the all-time highs, there are some serious issues brewing. And in this video, we're going to talk about the stuff that most YouTubers won't touch because they don't understand. Not just the headlines or the hype, but the real structural problem hiding in plain sight. More importantly, we're going to answer the big questions every new investor should be asking right now. Should I be investing at all-time highs? And then should they be putting money in the market when the economic data says trouble is on the way? The first serious issue comes from this article on Inc., the job market. Now, for a while, it felt like everything was great. And guys, with a lot of metrics, things are still great. Companies are hiring people, but companies were hiring much faster before. People were able to switch jobs much easily, and wages were significantly on the rise. But as of late, that momentum seems to be fading and fading fast. The truth is, there's a bunch of problems all hitting at once. First off, all that pandemic hiring we saw a couple of years ago, that wasn't built to last. Businesses were hiring ahead of actual long-term growth, thinking that the boom would continue on. But once the free money dried up and the spending went back to normal, companies realized they'd hired a little too fast, and now they're pulling back. Guys, Meta, Google, and Microsoft years ago said, we're going to hire ahead of schedule. As of late, they've pulled that back saying, we overhired by a bunch. We're going to lay off some people. And it's kind of hard to think about that when these companies are making $50 to $100 billion a year in free cash flow. But that's the reality. Second, the Federal Reserve started raising rates in early of 2022. That made borrowing much more expensive. So companies hit the brakes on hiring, on expanding, on everything. That shift really started to cool off the labor market. And now there's something new layered on top of that, technology. Companies are starting to rely on AI significantly and automation to get more done with fewer people. It's changing how businesses think about hiring. Even if the economy continues to grow, they may not need to hire like they used to. And we're already seeing it happen. Job openings have dropped significantly. The unemployment rate is creeping higher, albeit from very, very historical low levels. But people who lose their jobs are having a little bit of harder time finding new ones, and folks just aren't as confident about leaving the jobs that they have. So guys, here's the first chart. Job openings have collapsed since employers adjusted to normal hiring levels after the pandemic boom. And guys, as you can see, it's not straight down like this. It's a gradual decline. And guess what? This ain't going to go forever. Okay? That's just not going to happen. But right now, this peak, and we saw great levels still that were very high. It's slowing down. Seems to be leveling off right here, though. So that could be some good news for normal hiring levels. But look at pre-2022. During the pandemic, it really started to rise. Now it's slowing down a bit. So then the Fed starts hiking rates right here. And the biggest one people are going to point to, ChatGPT. Now, guys, I'm a big believer in technology doesn't permanently eliminate jobs. I don't want anybody thinking that's the case because I don't believe that at all. But jobs do adjust. And when a new technology comes out that can help people and help jobs, eliminate some jobs, it's going to do that. But then there's going to be some pullback. I'm already seeing it from people on ChatGPT. I've already found math errors on ChatGPT. That scares me. So why does this all matter to you as an investor? Well, guys, the job market, when it weakens, people start spending less. And consumer spending is 70% of the economy, maybe 68%. So if folks are worried about their paychecks, what do you think they're going to do? You think they're going to go out and buy extra stuff, go out to eat, go travel? No, and that's going to hurt corporate profits. And when profits fall, what's going to happen to earnings? It's going to mean that stocks are probably going to fall soon thereafter. Now, the market is still flying high right now, near all-time highs, but this is one of those issues that's a lagging indicator. What that means is it's later to the party. If things have shifted in the economy, stocks sometimes take a little bit of time to turn around. Just like when the economy is rebounded, stocks takes a little bit of time to do the same. And that's the problem. Everyone is watching for some big event, some scary headline, something like a financial crisis, a COVID, something like that. But they're not watching what really drives long-term returns, the fundamentals. And guys, that's what happened in 2000. We didn't have some catastrophic event in March of 2000. It just, all of a sudden, people realize, I have no more to buy. We've all bought. What is there now? And when fundamentals don't catch up, at some point, valuations matter, and they matter with a vengeance. I took this from John Hussman. There's a room filled with gasoline, and there's a fire in the corner. We don't know which spark will cause the explosion, but there will be a spark that causes the explosion. And I think the macro issues like unemployment, interest rates, inflation, recession, those are some of the sparks. But the gasoline in the room, it's valuation. When stocks are priced for perfection and the perfect story starts to fade, that's when things fall apart. Because when the cracks start to show, that's when you want to be calm. That's when you want to be prepared as an investor. You don't want to be the one that's panicked. And that's where we're here to help you become. All right. Now let's talk about the next risk we face that some people misunderstand. Slowing economic growth coupled with inflation. In this article, they're calling it early onset stagflation. We got some recent reports before the government shutdown that are making a lot of people nervous, and rightfully so. The U.S. economy, it's not falling apart, but it's definitely flashing some warning signs in areas that kind of matter. Consumer prices are up again. In fact, people are projecting out 4.6 or 4.7% inflation for the next year. Now, core inflation, the goal for the Fed for the longest time was 2%. And if you recall, core inflation excludes food and energy because how volatile it is. But it's still stuck around 3% and potentially going up. At the same time, unemployment claims have hit their highest level in 4 years. And we just saw a report about October job losses hitting a 22-year high for October. That means more people are losing jobs while prices are still going up. Now, stop and think about that for a second. That's not how it's supposed to work. Normally, if the economy slows down, prices come down with it. But when both unemployment and inflation are rising at the same time, that's a problem. That's what we call stagflation. If you guys recall, and maybe some of you aren't even old enough to remember this, obviously, I wasn't even born. The 1970s was filled with stagflation. And guess what? It came off massive overvaluation in the market. But we had a decade of rising commodity prices, rising oil, rising gold. All these things were happening, and the economy was going like this. That's stagflation, stagnant growth with inflation. And it's one of the worst economic combinations you can get. Like during inflation, like what we saw in 2022, at least people had jobs. Wages were going up, stimulus checks were going out, and even though prices were rising fast, consumers had the cash to spend. Painful, but manageable. And sometimes it took longer for wages to come up. But during stagflation, prices are going up and the economy slows. Jobs start to go away. So you've got people spending less, losing income, but still needing to pay for groceries, gas, and housing, and that's going up in price. It's a lose-lose situation for consumers, therefore for businesses, and therefore for investors if you're paying nosebleed prices and don't understand how to buy the right thing. So, what does the Fed do when this happens? Well, guys are kind of stuck. When they lower interest rates to stimulate the job market, they're going to make inflation worse. If they raise rates to fight inflation, they could make unemployment worse. It's like pressing the gas and the brake at the same time. It doesn't work like everyone wants it to work, which is immediate. If you go look at the early 80s, Volcker, the Fed chair at the time, said, I'm going to be unpopular. I'm jacking up interest rates. Inflation was such a problem. He said, this is going to hurt. And unemployment went to over 10.5%. Guys, we're currently in the low 4% range. That would be 2.5 times more than we are today. But guess what? It fixed the problem, but there was a lot of pain along with it. And with this kind of uncertainty in the air, where even the experts at the Fed don't agree on a clear path forward, it shows just how fragile this market really is. So yes, stagflation is scary. Yes, GDP growth is slowing. But here's the thing that most people miss. This doesn't mean you need to run away from investing. It means you need to invest smarter. The kind of investing we teach, principle-driven investing. It doesn't rely on guessing what the Fed's going to do. It doesn't care what the Fed's going to do. It doesn't rely on predicting inflation. It doesn't care what inflation is going to be. You're going to watch very few or any economic headlines. Now, one of the biggest elephants in the room, debt. And I'm not just talking about your credit card, your mortgage, your car payment. I'm talking about the United States government debt. This past year, the federal deficit hit $1.8 trillion. But it's not just a one-time thing. This is becoming the norm. And if this is the norm for you, what would happen? Our current national debt has crossed $38 trillion. That means as a taxpayer, your portion of that debt is now well over $100,000 and growing. One of the biggest reasons the deficit's growing is because the government has to pay more just to cover interest on that massive debt. In fact, interest costs alone hit over $1 trillion this year. That's just the interest. That's not even chipping away at principal. It's like running a giant credit card up and only paying the interest every month and just keep on tacking onto it. It gets worse and worse the longer you let it ride. So what's the government spending this all on? Well, Social Security, Medicare, Medicaid, all of those went up significantly. Why? Because the U.S. population is aging fast. More retirees, more healthcare costs, more benefits, and guess what? We're not making enough babies to replace those people in the workplace, to replace those wages so we can pay more in taxes. But then we got military spending, we got veteran services, we got disaster relief, programs helping to support farmers, all of which saw big increases too. And even though tax revenues went up, they didn't go up enough to keep pace. Plus, the latest legislation allowed companies to take bigger tax breaks, which means less money coming in from corporate taxes. Now, I don't want you to think I'm a big tax guy. I'm not. What I believe in is lower taxes, but I also believe in lower spending. When you don't spend less, you're just kicking the can down the road. You can cut taxes to zero tomorrow. Guess what's going to happen? You're going to have big deficits and you have to raise taxes even more at some point in the future. Now, what does all this mean for the market? Well, here's where principle-driven investing comes in. This is something I've been talking about for years, and I'm probably one of the few voices, if not the only voice on YouTube, who focuses on it. All this debt, all this spending, these are macro issues. They're the kinds of problems that can be the spark, but the real gasoline in the room that's going to cause the major fire is valuation. And right now, the room is drenched. It is flooded with gasoline. You've got a stock market near all-time highs with insane valuations. You've got a 10-year cyclically adjusted PE ratio that's at record high, second only to the dot-com era. Valuations will get better. There's two ways for valuations to get better. Price drops significantly or fundamentals get better. Actually, three ways or a combination of both. What's easier, guys? For companies to double their profit tomorrow or stocks to fall in half? If you think it's companies doubling their profit, you haven't been paying attention for very long. And this is exactly why I don't spend my time chasing headlines. I'm aware of all the issues out there, but I care most about the structure underneath the market, and that structure is valuation. And I realize that the chance of doubling profit versus stocks falling in half, it's more heavily leaning towards stock falling in half. When? I don't know. But when it happens, it'll probably happen when people are least expecting it. So when everyone else is talking about stagflation, the labor market, what the government's going to do next, I'm looking at whether price of a stock makes sense based on what businesses are actually worth, the value. As an investor, your job should always be one thing and one thing only. When you're buying individual companies, buy when price is below the value, not above. Guys, here's my personal stock market to GDP based on the S&P. We're currently 124% overvalued, with a fair value in the S&P of 3,000. Now, it's been overvalued for a very long time. I can scroll back here. We're talking about even during COVID, we were 30% overvalued at the end of the COVID crash. So it's been a while. Even after the bear market of 2022, it was 40 to 50% overvalued. We're at 124% overvalued. The last time we were there, guys, I'm going to put it this way. In 2000, we were only 50% overvalued. We have to go all the way back to the late 1920s, the Great Depression, 210% overvalued. And guys, the market for the next 10 years did negative 9.5% per year. That wasn't down 10% total, per year. This doesn't include dividends. Back then, they paid healthy dividends. But that's insane, guys. And guys, it makes perfect sense. Let's go look at 2003, the bottom of the bear market after the dot-com crash. We were undervalued by about 20%. Look at the next 10 years, 5% growth. Let's go here to 2009, June, undervalued by 30%, 9.8%, not including dividends. Let's go a little bit further back to 1982, after all the stagflation, the 70s lost decade. Look at this. We were 67% undervalued. We did 14% a year, not including dividends for the next 10 years. You seeing a pattern here, guys? Well, luckily for all of you, I put all the data in for you. We have 100 years of data, 400 quarters. The average return, not including dividends, is 6.4% for every 10 years on average. The more undervalued we are, the higher the return. The more overvalued we get, the lower the return. That's why you see 10.7 going to 9, going to 2, going to negative 1.1, negative 2, negative 2.4. And guys, the scary part is that's 50% or more overvalued. So this includes times that were only 50% and times that were way worse. So guys, big reason I do this on YouTube is because I like talking about things that people are not talking about. And the YouTube market, when I see what's going on in the finance channels, they just talk about a lot of hype out there. What's one stock that's moving fast? We don't care what's moving fast. What I'm here to do is teach people how to think, teach people how to fish, and teach people that when things are cheap, that's when it's better. That's not the world out there, though. The world out there is teaching you that following a stock price going up or down is the right thing to do. It is not. Understanding how to value a business and buying when it's undervalued, that's the right thing to do, because it'll make you calmer during bad times. Everybody else's bad times will be your good times. Don't you want that for yourself? So, what do we do here? What's the right plan? You can't control the government. You cannot control inflation. But what you can control is whether you're overpaying for a company. And that's why, especially now, understanding value and how it works with price is everything. It keeps you focused on what matters, so you're not blindsided when the rest of the market wakes up to reality. And guess what? They eventually will. So let's take a little bit of a time to talk about this thing I keep talking about in every video, the difference between price and value. This is the key difference between true value investors and speculators. This is the heart of principle-driven investing. This is how real wealth gets built. So guys, here's the deal. Price is what you pay, value is what you get. Philip Fisher has a great quote. The stock market is filled with individuals who know the price of everything but the value of nothing. I don't want you to be that person. I want you to be the person who understands the value of everything and uses the price to determine what you're going to do. The market jumps around every day based on emotions, based on headlines, based on hype, all kinds of noise. And we say all the time, news follows the stock price. If stocks are up a ton, the news to justify that will come out. If stocks are down a ton, the news to justify that will come out. But the value of a business won't swing like that. That's where the opportunity is. See, when you understand value, when you know how to analyze a company, you don't get caught up in the day-to-day price moves, or you don't worry about all the macro issues that could potentially bring down the market. You look at a stock and ask, what's this business actually worth? What kind of return can I get if I buy this today? But I'm not talking about a return over the next 3, 6, 9 months. I'm talking about years. And that takes a different kind of person. That's the kind of person I want you to be. That's what a true investor does. And guys, I don't want to buy a good business at any price. I want to buy great businesses at great prices. That's how you protect your downside and set yourself up for real upside, because the real upside is made when you're calm. So if you understand how to value a business, and when you understand that the price is below that business value, that's your chance to be calm and pull the trigger. It's not about guessing what the next hype stock or timing the market perfectly is going to be about. It's about building a system that works, a system that gives you confidence, especially when the market is going crazy. If the price drops and value stays the same or goes up, why would you not be excited? I get excited. And once you get that, once you really get it, you're never going to look at the market the same again. Guys, I know exactly how it feels to be paralyzed by fear in the stock market. You're probably thinking, I know I should invest, but what if I buy the wrong stock? What if I lose everything? I had those exact same fears 25 years ago. I made massive mistakes. I followed hype, I followed tips, and I lost money. But critically, every mistake taught me a valuable lesson about investing. And that's exactly why I decided to build Everything Money, to take that knowledge and turn it into the tools I needed to make better investing decisions. Now, I want to share that knowledge and those tools with you and build the community that I wish I had back then. So join our community and you'll learn how to see a company's value, how to make smart choices, and most importantly, how to sleep at night knowing that you aren't gambling anymore. You're now an investor. So start your 7-day trial today. Let's take the fear out of investing together. So there's a couple questions I want to answer. Should you be investing at all-time highs? If you're dollar cost averaging in a low-cost ETFs, absolutely. We never know when the ups or downs is going to be. When I dollar cost average, I'm dollar cost averaging in a low-cost ETFs as we speak. I do that because I don't know what the future holds, short-term, long-term, all that stuff. What I do know is I want the habit being formed. But the question becomes, am I buying individual stocks at all-time highs? And the market, I still am. I own 28 companies right now, but I didn't buy them at their all-time highs usually. I buy them after the opportunity comes, and that usually comes after the fall of the stock price. 2, I get this question every live stream you get. I get the question, Paul, with the economy looking the way it is and all stocks at all-time highs, should I be putting money in the market? Guys, first off, who cares about the economic data? I loved it. It changed my way of viewing the world when I heard what Warren Buffett said. He once said, if I had the Fed chair tell me exactly what he's going to do for the next year, I wouldn't change the way in which I invest. When I first heard that decades ago, I was like, that's crazy. Now I go, yeah, it's pretty obvious. That's the framework I want you to have. The Fed can raise rates, lower rates, whatever. Your job is to find good companies at good prices. It's absolutely there. Now, the stock market is insane right now. It boggles my mind every day. We have a little group chat and Everything Money worker, the employees here at the company, and we're like, this is insane. Like another all-time high. It moves around like nothing's wrong. But here's the truth. You don't have to let the market's chaos drive you crazy, because we don't invest based on emotion or headlines. I laugh at these things that happen. I'm following principles. I have a process. I stick to it. No matter what the market's doing, I want you to be able to do the same. At Everything Money, we live by 5 simple but very powerful tenets of principle-driven investing. 1, we are investors, not speculators. This means we understand the difference between price and value. 2, every investment is the present value of all the future cash flows it's going to generate. So the more I pay for something, the less return I'm going to make, because those future cash flows are what they're going to be. So if I pay a ton more for it than I could down here, how's my return going to be better? It's not, it's going to be lower. 3, if we don't understand it, we don't invest in it. 4, in the short run, the stock market's a voting machine. In the long run, it's a weighing machine. And 5th, and probably most important, a great story becomes a bad investment if you pay the wrong price. These rules keep us grounded. They keep us focused on the task at hand, price versus value. They help us block out the noise. So if you're tired of feeling overwhelmed, if you're confused when markets go down, don't know what to do next, this was made exactly for you. Click the link in the video description. I put that is 5 tenets of principle-driven investing as a cheat sheet for you in there in an absolutely free PDF. I gave you the 5 tenets. I explained them so you can have it right then and there when you need it. Guys, do what I do. I read them pretty much every day because it's about ingraining that in my subconscious. It's short, it's simple, and it will change how you think about investing forever if you stick to it. Now, if you're serious about becoming a better investor, it all comes down to one skill: knowing how to value a business. Prices are going to jump all around. You've probably mastered buying low-cost ETFs every single month. The market is just going to do what it does. But value, that's more steady. And once you know how to calculate it, the noise doesn't shake you anymore. I believe there's a moment coming when stocks will be much cheaper. And if you've got the skill ready, which you need to get ready now, you'll be the one making the smart moves while everyone else panics. So in the next video, I'm going to show you exactly how I value a company step by step. You're going to learn what to look for, what to avoid, and how to protect yourself from overpaying for hype. Because let's be honest here. Most people are trying to find the next best thing. Good investors are trying to eliminate the crappy things. So the link is right here on your screen. Click it, and I will see you there.